So today what I want to talk to you about is the listed infrastructure sector. I want to refresh you on some of the key attractive characteristics of the asset class, talk to you about some new themes which are impacting the sector and the importance that understanding the movements of capital within the direct infrastructure have when investing in the asset class. I want to explain the importance of having a broad universe when investing in infrastructure, and finally explain why we think the sector has a pretty favourable outlook when you look at the market today. So if you look at this slide here, let's just step back and think about what is infrastructure assets and how are they defined. Well, infrastructure assets are defined as high value assets, physical assets that are vital to a country's economic development and prosperity. And when we think about infrastructure, we break it up into four main categories you can see here on this slide. We think of it as utilities, things that are distributing typically gas, water and electricity. We think about digital communications, things like telecom towers, data centers and fiber networks. Think about energy or pipeline type companies which tend to transport oil and gas. And then of course there's the transport infrastructure asset classes. So things like airports, toll roads, railroads and ports that I'm sure you're all familiar with. Now each of these individual subcategories have some very different characteristics and drivers. But there are a number of common characteristics which bring them all together and make them infrastructure. And the first one of that is that they do have high barriers to entry. Now, these assets are monopolistic in their nature, and the beauty of that is that it does reduce the level of the risk of competition and also supports pricing power for the owners of those assets. The assets themselves tend to be essential assets, and they have consistent demand. They're the type of assets that are used every day, and there's demand for them regardless of what's going on in the macro or political environment. So it makes them much less cyclical than other asset classes. And the other attraction is they tend to have defined revenue streams. They tend to have regulated or long-term contracted cash flows that are often linked to inflation. Now, all of those factors together result in predictable growth. And so for investors, they get a very good certainty on the recurring cash flow streams that are going to come back to the end owners. Now, one of the other attractions about the asset class is that there's always opportunities to reinvest in the sector regardless of what's going on in the macro conditions. Infrastructure assets, as a rule, tend to age over time. Regardless of, there's constant reinvestment requirements to upgrade or replace for safety, reliability or efficiency purposes, regardless again of what's happening in that macroeconomic or political environment. And this attribute means that there's constant long-dated opportunities to reinvest into new and existing assets. And the OECD estimates that there's around $6.3 trillion of annual investment required in the infrastructure space to support the growth and development of the global economy. And that's a huge pipeline of investment opportunities for infrastructure investors. I think one of the other attractions of the asset class is that, unlike many other asset classes available, the return that's going to be received on that investment is typically known up front because it's typically done under the construct of regulation. So I'll give you a couple of examples. You think about the utility space, for example, and when a regulated utility is thinking about needing to upgrade its infrastructure, potentially to protect against bushfires or to potentially increase the technology to allow for the dual flow of energy when we're having more solar panels on our roofs, that spend that they're going to be investing into their networks, they already know up front what the return they're going to get on that asset, that spend is. If you think about a toll road like Transurban, for example, when the Victorian government goes to Transurban and says that they want them to put a new road in to ease congestion, Transurban's able to negotiate a fixed price escalator within whether existing roads or some form of concession extension. So they again already know the type of return they're likely to get on that investment before they spend their first dollar. And that's a real attractive point of difference versus many other asset classes. So let's look at what are some of the investment benefits of investing in infrastructure. Just a quick refresher, I'm sure you're familiar with many of these, but just to remind you, the sector itself has delivered very attractive long-term absolute performance and also relative performance versus other asset classes. It's giving a very attractive dividend yield, around 3.5% today, which is again covered by those regulatory cash flows and with scope for growth going forward. The the companies themselves, their revenue streams tend to be linked to inflation or some form of indexation in terms of price growth. And so that does protect against rising interest rates. And the demand for infrastructure assets is relatively inelastic and predictable. And that as a result reduces the earnings and dividend volatility, which is particularly attractive in this type of economic environment we're in today. And finally, they have low correlation with other major asset classes, which provides diversification benefits for investors. So I'll just step into some of these in a little more detail. We just think about the performance of the sector, and this chart here shows the three major asset classes, their global performance over a range of timeframes. You can see their 5, 10, 15 and 20-year timeframes. And the global infrastructure market from a listed perspective is represented with the red bar chart. And as you can see, the sector's been able to deliver both from an absolute perspective, over 15 years, 10% return, over 10 years, 12% return, very attractive from absolute, but also relative, in line or better than most of the other major asset classes. There is some investors that see infrastructure as being a bond, and you can see there from the returns that the sector is certainly not a bond in terms of the total return that's delivered historically. But one of the other attractive elements is the yield that the sector offers, and that's particularly relevant in the current economic climate. You think around the fact that bond yields in Australia today are around 1.2%. You can see there global bond yields today sit around 1.3 on long-dated 10-year bonds. And if you look at parts of Europe, there are parts of Europe where bond yields today are negative. So for investors searching for yield, the infrastructure sector is a really attractive way to get that. And it is quite an important part of the total return. You can see there that on the right-hand chart, the difference between the price return or capital growth and total return is that income return, and how over time it's quite a strong contributor to the overall total return of the asset class. I think one of the other appeals of the asset class is the low levels of volatility of the underlying cash flows. The vast majority of infrastructure assets have some form of inflation or index-priced growth, which when you combine with the essential nature of the assets has provided relatively low levels of earnings volatility through history. This chart here shows how operating earnings growth from the three main against global equities. And you can see here that relatively consistently over time, the infrastructure market's been able to show steady earnings growth. And that means that in times of economic uncertainty, such as the type of environment we're seeing today, investors can get some certainty around the cash flow growth and earnings growth they're going to get from the sector, and that does tend to attract a higher multiple in these types of environments. And you can see there the superior earnings growth that the infrastructure sector, which is represented on the brown line, has been able to deliver versus the earnings growth of global equities. I think that brings to the next point around the fact that the asset class is very defensive. I want to cast your mind back to the fourth quarter of last year, and there was a lot of uncertainty at the time. We had Trump fighting with China and trade wars occurring. You had the uncertainty surrounding Brexit, and that led to a lot of uncertainty in equity markets. And as you can see there, that resulted in some material volatility in share prices. If you look at some of the major global equity markets, they're off anywhere between 7 and 17% over that last quarter of last year. Compare that to the global infrastructure market, which was relatively flat over that time frame. So it really does show that the fact that the earnings stability does provide some defensiveness from a share price performance as well in times of economic uncertainty. And that's borne out not just in that last quarter of last year, but through history. And what this slide here tries to illustrate is the downside and upside capture of infrastructure versus global equities. And you can see there that, for example, over the last 5 years, in periods when equity markets have fallen, the infrastructure market has had a downside capture ratio of just 39%. So that means that if the equity market was down 10%, infrastructure was down just 4%. And a similar type of stats over 10 and 15 years where it's been around 50%. But whilst you had very good downside protection, you've still been able to participate in most of the upside, with the upside capture ratio being around 75%. That's obviously a pretty compelling defensive attribute to share with your clients. This slide here shows the historical correlation between the listed infrastructure sector and other major asset classes. And as you can see here, the correlation between infrastructure and other asset classes has been relatively low over a 5 and 20-year time horizon, as you can see on the right-hand side there. For example, over the last 5 years, the correlation with US bonds has been just 0.4, and against equities, 0.6. So again, it's a really good diversifier for your client's portfolio, but again, without having to sacrifice total return. The other feature to think about from a correlation perspective is that there are numerous asset classes within infrastructure. I talked about some of them before, and we break them down into 10 main sub categories. And there is a relatively low level of correlation between those subcategories within infrastructure. In fact, the average correlation is around 0.4. So that provides diversification within the infrastructure sector itself. And because there is quite a low level of correlation between those sectors within infrastructure, there does tend to be quite a wide dispersion in terms of performance within the individual sub-asset classes from any year to the next. So there is opportunities for an active manager to be able to add value by selecting the right sectors within the infrastructure space. So let's change tact a little bit and talk about some of the changing dynamics that are impacting the global infrastructure landscape. And we think there are a number of major changes that are going on in the global infrastructure landscape at the moment that require a bit of a different approach to investing in the asset class. And the first point that I want to talk about is the fact that there are a lot of private infrastructure investors investing in the asset class at the moment, and that's really influencing where valuations in the asset class is moving. And so for a manager, it's very important to have a perspective and a handle on what's happening in the direct infrastructure market. The next point I want to talk about is the fact that core infrastructure sectors are evolving. We're moving away from a lot of traditional infrastructure asset classes to new high growth sectors, which do have those same attributes as infrastructure. And so it does really require a much broader perspective of what infrastructure is and a much wider universe than I think what historically has been seen as being traditional infrastructure. And finally, there is a lot of unexpected events that are occurring around the globe from a regulatory, political, or asset-specific event perspective. And so having a diversified approach when you're constructing a portfolio is very important. So I might just start by talking about the first part and the role of the private market in the infrastructure space. And over the last few years, we've seen an explosion of demand for infrastructure assets from private institutional investors, and particularly from pension funds around the globe. There's around 950 institutional pension funds today allocated to the asset class, and their target allocation today sits at around 500 billion. And we expect that to increase by around 250 billion over the next few years. But it's not surprising the asset class is attractive to those pension funds because obviously you're getting a good yield, long-dated cash flows, and it's matching against their long-dated liabilities. And we're seeing that in terms of the capital that's being raised by private direct infrastructure funds. It's been a real trend that's been playing through the last few years. Look back in 2018, $94 billion of capital was raised in those unlisted funds to invest in direct infrastructure. That was up 21% on the previous year. And this year, the target capital raise is around 194 billion, so more than double the amount of capital that's been raised this year alone. And the capital is being raised so quickly that these direct infrastructure funds can't get that capital deployed fast enough. We estimate that today there's around $180 billion of dry powder. That's capital that's been raised but yet to be deployed into the asset class, which is likely to be deployed over the next couple of years. And so that is really putting upward pressure on valuations in the direct infrastructure space and helping to underpin valuations in that sector. I think what's interesting is that these private infrastructure investors are really setting the marginal price for and IRRs for infrastructure assets, and we believe it's really important to have a good handle on how these investors are seeing the world. We're very fortunate as part of the CBRE Investors platform to have Caledon, which is a business that CBRE bought a number of years ago, which is a direct infrastructure investor, manages today around $7 billion of assets. It's got a team of around 21 investment professionals around the globe and around 20 years of investment experience on average across those investment professionals. And we integrate them very heavily into our investment process because they give us a very good handle of what's going on in that direct infrastructure space, some of the trends around where those direct infrastructure asset investors are allocating their capital, trends around pricing that's being paid in the individual asset classes, and it does help with our underwriting when we're investing in the asset class. It also helps when we're thinking about regulation within subsectors within the market. But what's interesting is that if we look at where the listed market trades today versus where the direct market's trading today, we're seeing at the moment the listed market is trading on a significant discount. This chart here, or this illustration, shows where the listed market trades if we look at a basket of listed infrastructure sectors versus where a basket of direct infrastructure sectors have traded in the last couple of years. And you can see there quite a wide valuation gap between the two. And as a result of that, the implication is that for a lot of direct investors, they're now looking to the listed market as a good way for them to be able to get access to infrastructure assets at a much cheaper valuation. And that's playing out in the form of privatizations. And so we've seen a real pickup in M&A activity in the last 12 months. There's been around $43 billion of privatizations across the globe in the listed infrastructure space across a wide variety of asset classes. You can see there on the top graphic that it's come across a wide variety of sectors. And the average premium that's been paid for these assets is around a 34% premium to the last traded price. There's some recent examples here in Australia. If we think about, it wasn't a privatisation, but of a direct infrastructure asset that traded. Hobart Airport was obviously a regional airport in Tasmania, was bought by a couple of institutional pension funds, QIC and a Dutch pension fund called Schiphol. They bought that asset on a 26 times EV to EBITDA multiple. You compare that to Sydney Airport, which trades today on the Sydney market on a 20 times multiple. So that valuation gap between the direct market and listed market is very stark. And we think if that gap persists, we're likely to continue to see that M&A activity, and that helps to underpin valuations in the listed market. So just moving next to the broader universe, and just wanted to, I think it's very relevant for those there on the call which are considering trying to get exposure to infrastructure through passive funds and through index funds. This sector really is one where there is opportunity to add value through a specialist manager. And we think there are some flaws with many of the indexes that are out there today. They don't really, in our view, capture the full suite of investment opportunities available in the infrastructure space. And as a result, we take a much wider perspective of what is infrastructure. And as a result, our universe today is very diverse in terms of, from a regional perspective, as you can see on the top left-hand side, and also from a sector perspective, as you can see on the right-hand side of the chart. That being said, we do still require that the investments we're investing in have those core investment characteristics. They need to be long-duration assets, high barrier to entry, defined revenue streams, and have consistent demand. They need to be infrastructure assets. And all the assets that we're looking at and sectors that we're investing in and companies we're investing in, including our universe, are the same that those direct infrastructure investors consider to be core infrastructure. They're the same types of asset classes that these direct infrastructure investors are investing in today. Now, I think what's interesting is looking at some of the new emerging asset classes which aren't included in the traditional view or the index view of what infrastructure is, and some of the positive characteristics and growth drivers that are coming from those sectors. And I'll talk to a couple of them right now. And the first one is the communications infrastructure sector. It has been included in the past in the form of telecommunications towers, but there are other asset classes which are now starting to be added. And the communication sector is a really interesting one. When we think about the role that the increase in data consumption is having on that sector. Now, there's a really interesting stat that 90% of all the data that's been created through history has been created in the last 2 years. Our demand for data is growing exponentially, as we move to watching movies straight on our phones and on our devices, our handheld devices. We're storing our photos and our documents no longer on our PCs and laptops, but we're storing them up in the cloud to be accessed at any point in time. And we think about the future and we start moving towards driverless cars and what that means around the requirement for additional data, that's likely to continue to increase in the future. And that's creating great opportunities for infrastructure companies that given the fact that we need to process that data, we need to store that data, and we need to transmit that data from place to place. So, for us, these assets are essential assets. They have consistent growing demand. They have high barriers to entry, and which is providing pricing control for them. And they're attracting core infrastructure capital. We've seen that recently with some transactions which have occurred. One occurred just a couple of months ago in the US. An infrastructure listed company called Zayo was acquired by a Swedish pension fund called EQT, and that was a $10 billion deal done on a 30% premium to the last share price. Another really interesting structural trend that we're targeting at the moment in our fund is the move towards decarbonisation. And this is a global theme that's driving investment opportunities for integrated utilities, regulated utilities, and selected energy companies. What we're seeing here is obviously a move away from coal and nuclear towards renewables, and that's creating great opportunities for these infrastructure companies. One good example of that is in the gas space, which is where we're seeing a big pickup in demand for gas from parts of Asia and also parts of Europe, which is moving towards cleaner and more reliable energy sources versus coal and nuclear. And that's seeing a pickup in direct infrastructure investments into LNG export facilities, particularly in the US, and also gas pipelines. The US is a market where there's been a lot of cheap gas found recently. And so as a result, new infrastructure needs to be created to connect where those gas fields are in the middle of America to the coastal points, and new LNG export facilities need to be created to ship that gas through to where the end consumers are in Asia and Europe. And so many of the listed companies that are exposed to this theme, particularly in the LNG export facility market, aren't included in the main indexes, but are in our investment universe. I think the final trend I wanted to point to that's occurring across the globe at the moment is a real rise in the number of idiosyncratic risk factors that have really impacted share prices in the listed infrastructure sector over the last couple of years. We've seen a big pickup in specific events over the last 2 years, which have materially impacted valuations across a select number of stocks in the investment universe. So we've had some events, like you might be familiar with some of these. We've had big wildfires in California, which materially impacted the valuations of some of the utilities in the US. We had a bridge collapse in Italy as a result of underinvestment, which had material impacts on some of one of the transport stocks in Italy. We've had political upheaval in Hong Kong, regulatory uncertainty in the UK, and political risk, which has had big impacts on some of the stocks within that sector. And they've all had pretty dramatic impacts on share prices. And we think, given that sort of backdrop, it's very important to have an active manager who's able to actively focus on the risk of these events. But even with that being said, it is quite hard to predict some of these events. So it's important that you do have a construct a portfolio which is diversified. And so as a result of that, our portfolio construction is set up in a way whereby our maximum bet tends to be around 6% in any one company. And we have a diverse portfolio of around 45 stocks across a wide variety of asset classes to protect against some of these unforeseen idiosyncratic risks, which are having quite big impacts on share prices in the market. So just to finish off, let's talk about the investment outlook for the infrastructure sector and why yourselves and your clients should be investing in the sector today. Well, in the current environment, looking at pricing today, we still believe, even though the sector has performed very well over the last year and over a number of years, a 10 to 12% return is still achievable in the asset class over the next 12 to 24 months on an annual basis. That view is based on the fact that the sector is starting with a pretty attractive 3.5% dividend yield. And on top of that, we estimate that the sector is able to deliver around 7% earnings growth per annum over the next 2 years, being supported by the fact that they do have these inflation-driven revenues and accretive reinvestment opportunities within their asset classes. The sector has a lot of very attractive attributes, which is particularly relevant in the current uncertain economic climate. You have that stable, predictable earnings stream, supported by the essential nature of the assets, and obviously the pricing structures I talked about before. And the fact that the sector does continue to have a need to reinvest, and there are opportunities for growth within the sector regardless of what's going on in the macro environment. And finally, we think the valuations in the sector are still attractive. It's providing good capital upside opportunities for investors today. I talked before about the fact that the listed market is trading at substantial discounts to where the direct infrastructure market is trading, and the fact that there is still huge amounts of capital that have been raised in that direct infrastructure market that needs to be deployed, and increases the scope for M&A activity in the listed market. And that should help provide a downside protection to the listed market. If I look now just to the to how the sector trades against equities, and how we still see pretty good value again versus equities, the chart on the right-hand side shows that despite the strong performance of the sector versus US equities, the multiple has actually derated versus US equities over that time frame. It's actually got cheaper versus equities. We also point out the fact I talked before that the yield that's on offer, 3.5%, but what's important to think about when you think about that yield is it's being paid out off a payout ratio of just 60%. So the companies are retaining a lot of capital to reinvest into growth within their businesses, and that's helping to generate that 7% growth that we expect in the sector over the next 2 years. The final point to note is around leverage. Sitting around 34% today, that's not particularly excessive. The companies have clearly learnt their lessons from the past. The tenor of the debt across most of the infrastructure companies has also been expanded. So as a result, they're a lot less susceptible to any sort of unforeseen credit crunch event like what we would have seen back in 2007 or 2008. The final point I note is that the debt costs that most of these companies have today that are locked in from a hedge perspective are well above where spot rates are today. So that should be a good tailwind to earnings if interest rates stay where they are today. Just to draw a little bit further on how we get to that 10 to 12%, this is a very simple graphical representation of how we think about the building blocks to get to that level of return. And we start with the dividend yield sitting around 4%, 3.5 to 4%, again coming with a 60% payout ratio. This is very bond-like in its nature, tends to be locked in every year from those contracted cash flows. The companies then get an additional 1 to 3% from inflation and fundamental volume growth that's coming through given the essential nature of what they're investing in, and the growth that's coming through from population growth across most of the regions that they're operating within. And then there's additional growth of around 3 to 4% that comes from reinvesting of that 40% of retained earnings they keep back and reinvest into a high yielding investments in often their existing assets they own already. And on top of that, there are opportunities for additional growth, that 1 to 4% you can see at the end, if you're investing in some of those higher growth asset classes, like in the communication space and also parts of the renewables sectors, which have higher growth opportunities as well. So there's opportunities for an active manager to position their portfolio towards some of those higher growth markets to be able to get that higher level of return. So just to finish off, just a couple of very quick points on us as a manager and why we think we're different and the benefits of investing with us. We think one of our key points of difference is that ability to have the private infrastructure business within our platform. I've talked before about the importance of having a handle of what's going on in the direct market, and we think it gives us an information edge when we're underwriting regulation, transaction volumes, and also valuations. It's very important to have a global team. We're located across 5 markets around the globe with investment professionals in all of those markets. Gives a good perspective of what's going on in those domestic markets from a political and regulatory perspective. It's very important when you're investing in the asset class to have a broad investment perspective, and we talked about how we have a much wider investment universe than where the index has. But that being said, it's still in line with where core infrastructure investors are focusing. And it's important to have as well a high conviction approach, but still having that risk mitigation from a portfolio construction perspective as well. And the final slide there just shows the performance of our strategy over time and back to inception. I'll just pause there and see if we can had any questions might have come through while I've been talking there today.
Excellent. Thanks for that, Gavin. Yes, we did have some questions posed by the listeners today. Firstly, that was a very interesting look at the attractive elements of infrastructures as an asset class. Just looking at the questions from the group, we'll look at about 4 questions, but the first one I'd like to ask is, what global infrastructure projects are you excited about at the moment?
I think one of the markets that's really interesting is the LNG export market that's happening in the US. I talked before around the fact that it only really has been in the last sort of 5 years or so that they've discovered a lot of cheap gas in the US, and so the US has gone from an importer of energy to being an exporter of energy, and so there really is a lot of infrastructure that's being created in that asset class to facilitate the export of energy and gas in particular out of the US into other markets. And LNG in particular is one which we think is very exciting, and there's some companies like Cheniere Energy that we're exposed to, which is building some of these LNG export terminals in the Gulf of Mexico in the US. And the attraction of that as an asset class is they do tend to have very long dated contractual agreements with their end users. They tend to have sort of 10 to 20 year contracts. They tend to be fixed price and in many cases fixed volume. So there is a lot of certainty, but there's also ability for those owners of those LNG export facilities to expand on those networks in time as demand continues to increase and increase the return out of that asset class.
Excellent. I hope that answers that question. Another one that's just come through. What impact will increasing interest rates have in the future?
Yeah, I think that is obviously a fear for many investors investing in the asset class. We've found through time that listed infrastructure does tend to underperform equities in times when we are seeing rapid increases in interest rates. But the sector is still able to provide positive returns in that type of environment. One of the attractiveness of the asset class is that the reason why interest rates tend to be increasing tends to be because you are getting inflation. And so, when interest rates are rising, you tend to have the offset for these companies that their earnings are growing every year. The other beautiful thing about the infrastructure sector today is they do tend to, as I mentioned before, have very long dated debt books. And so as a result, as I mentioned, the current cost of debt or the spot or passing cost of debt versus where the cost of debt in their books are today, there's still a lot of headroom for interest rates to be increasing before that starts to impact on their earnings.
Excellent. Thank you for that. Another one that's come through. In recent time, how have infrastructures compared to other global indexes? Well,
I think you can see there on that slide we talked to earlier. I can probably pull it up now on the chart if this comes up for the viewers. Hopefully it does. Just the return of the asset class. Here we are. Here you can sort of see, the sector has materially outperformed equities and bonds. I think if you look on the last 12 months, the sector has also been able to deliver close to 20% return, which has been stronger than global equities. As I mentioned before, I think one of the real strong attributes and attractions of the asset class is, whilst it has been able to deliver good absolute returns and also relative returns, what's been really attractive is in some of those periods where we've seen volatility and we've seen the market come off dramatically, the listed infrastructure sector has held up quite well. And I think that's really one of the key points we want to get across around the attractions of the asset class versus other investment classes that are available to investors.
Excellent. Thanks for that, Gavin. One final question I have here. What trends are you seeing in the technology and renewable energy space?
We talked a little bit to that earlier, but we are seeing a lot of infrastructure being required to facilitate the rapid increase in data that's being processed at the moment. I think one of the trends is the increased demand for data centers, and they're getting a real strong take up. And when we're looking at data centers, there are a number of different types of data centers. There are very simple data centers that just tend to be occupied by or used just by single users. But there are the sector that we're most excited about is those co-location data centers, which have all different types of users. They might have a Microsoft in them, an Amazon, and different telecommunication users as well. And the importance of those data centers is that all of those users want to be close to one another, so there is speed of connection between those users. And we think that's an asset class which is seeing really good growth in different markets around the globe. The other one is in the telecommunications tower space. We're moving away from 4G to 5G. That's creating fantastic opportunities for many of the companies in those asset classes, as the telecommunication companies are looking to upgrade their technology. It's resulting in, for many of those companies, the ability to put new investment into those towers, extend the length of their leases of those contracts, and increase the pricing, which is driving stronger earnings growth for those corporates.
Excellent, thank you. Well, that's all we have time for today. Any questions that we didn't get to, I'll pass on to Gavin and the team to follow up after today's webinar. Firstly, thank you for sharing your insights today, Gavin, and thank you to all the listeners for joining us. Just as a reminder, if you've been online for at least 30 minutes of this webinar, you'll receive your CPD points and the follow-up slides for this webinar within the next week. In case you're interested, you can compare over 400 managed funds and models and their performance on our platform, including the UBS Clarion Global Infrastructure Security Fund, by visiting our Compare Funds and Models page, which can be found on our website under the Personal tab, then Research and Tools, or if you're logged in, it's under the Forms and Research. From the NetWealth team, we'll see you next time.